Originally, we were just looking at the price of oil and we're saying, okay, that says something about demand overseas, not in the US. The US should be good. But then consumers didn't really start spending based on lower oil. Then we had the stock market drop in the US and we said, okay, well, that's just the market, that's not the economy. Well, this week we also saw some weak numbers from manufacturing, and we saw that banks said they were going to tighten up some credit, their credit standards on companies. They're going to start lending a little less to companies have more scrutiny. And that is kind of in past recessions. It doesn't always lead to a recession, but that's often something that happens before recessions. Banks say, okay, we're worried about lending.
But Nick, sometimes for every data point that is negative, you see a good one. Like today, we had a jobs report that was pretty good.
Sure, and I can cite a few more. Auto sales were great. Historically, recessions are linked to high oil prices. Now we have low oil prices. I think it's particularly murky right now, but I agree with Steve that there are more reasons to be concerned than maybe there were even a few weeks ago.
It's gotten so kind of he said, she said that I started keeping a list. So I have a list of indicators, and Steve, you mentioned many of them. Oil, China slowing, GDP 0.7% last quarter, retail sales, lackluster earnings, manufacturing contracting. I mean, you mentioned some of these. Downturn in capital spending, inventory destocking, yields on bonds have fallen.
Right, we had corporate profit recession. We have 3 quarters of negative growth for corporate profits. That doesn't happen that often without a recession.
Right, and so, and under the good column, I only have 3 or 4 things. Well, one thing that people say is that, so much of this is due to the energy sector. Oh, don't worry, it's just the energy sector. Well, the energy sector is ginormous, right?
Well, sure, and its role has kind of inverted, right? Historically, low prices were great, right? Like we can all drive, we can do, manufacturing benefits. But now as an employer, it's just such a huge part of the economy, the huge areas of North Dakota and Texas that rely on these jobs that are just, evaporating by the second.
So Steve, put the odds on the table for us. I mean, what do you think the chances are that we're going to see a recession this year? A real one?
The odds are still, maybe 30%, 30 to 40. We're still most likely not going to see a recession, but it's what we're probably also not going to see. We're probably also not going to see 3 to 4% GDP growth. Right. The U.S. isn't going to be able to pull out of the weakness that's happening in the rest of the world economy.
And some of this might be we are in an election year. The Fed is no longer is going to raise rates if things are still okay. They're definitely not going to support the economy anymore. So is some of this the fear that the economy kind of doesn't have the the government's not going to come in and prop it up? Nick, do you think that's part of it?
Fear is always huge. And I think fear is what is driving the market down today. Fear precisely because the jobs numbers, though not as good as hoped, were somewhat good and, the lowest unemployment rate in 7 years. People are afraid that interest rates will go up. And so, yes, fear absolutely, always.